Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is the last day of the month, February 27th of 2023. Hard again to believe how fast time flies, but when we look at the month of February, clearly it's been defined by an organized and persistent pullback in the overall market. That's normal as we come off bottoms. We know that January was an excessively strong month. And so ever since then, we've seen the market really catch its breath after that February 2nd peak. So we're going to go through all of that today. I know that after a very rough 2022, that there's a lot of impatience out there in terms of let's just get back these losses, let's get back to the highs, and we could not agree more. But there is a process during a recovery. Markets don't go up in one straight line. When you have a really strong month like you do in January, you tend to get a bit of a pullback and it tests people's patience. So we're going to go through all of that today. And what makes this week's update a little bit unique is there's no real underlying theme other than we're going to do what's called a technical market review. Now, we can go through a lot of economic data and earnings and what the media is saying and all that kind of stuff. But sometimes we just like to look at what the charts are telling us, because sometimes the charts can help us, really drown out some of the noise that may skew how we look at the market. So we're going to go through all of that this week. Three big things we're going to look at. Inflation expectations have started to rise. What does that mean? Also, how we think interest rates drive financial conditions. And why is that so important? Because financial conditions really impact the short-term and medium-term movement of asset prices. And then lastly, our thoughts on the relationship between financial conditions and asset prices. So we'll go through all of that. Now, to start, we want to bring back this chart that we showed everyone last week. I think it's really important. I think it's probably one of the more important charts that I can think of for this year. And that is the percentage of investors that believe that a recession is likely. That peaked in November of 2022, just a couple of months ago. Previous peaks we saw, April of 2020 and March of 2009. Both of those dates were important secular bottoms for the overall stock market. We don't really believe that this is all that different. When you do get that level of crowded thought as it relates to recession, guess what? Asset prices reflect that. So a lot of risk premia that's been priced into the market. So we want to make sure we're paying attention to that. And that's why investing is hard, because in March of 2009, April 2009, May and June of 2009, the economy got worse, but the market actually bottomed in March of 2009. So let's not get too caught up in the headlines and the media and the uncertainty and all those types of things. We've had a lot of risk that's priced into the market. The question, I think, and I think the challenge this year is really going to be, how do we look at asset allocation? How do we look underneath the surface of the stock market and separate the S&P 500 price action from what's taking place at a sector by sector level? That's going to be really, really important for success this year. So when you look at the S&P 500, we've really been in this longer term range since May of 2022. So it's kind of buffeted by 3,600 at the bottom, 4,200 at the top. We've had this range that the market's been trading in. And sure enough, as we got to 4,200, we've had this pullback. Now, what makes this particular pullback a little bit different than the prior pullbacks is we've only had one distributive day, which occurred earlier in the week, where we had, I think the S&P was down 85 handles or so. That was an important distributive day. That was sells outnumber buys. I think it was about 9-1 or so. But ever since then, it's been relatively organized, right? And versus the prior pullbacks, we had clusters of distributive days, and we just haven't seen that this time around. Now, could it happen later on? Sure, it could. But so far, it hasn't. And we have to pay attention to what has happened, not necessarily what we think will happen. So far, we've been trading in this range. And underneath the surface breadth indicators, the level of stocks participating in structural uptrends has actually been expanding while that was contracting in prior pullbacks. The one thing that has changed here in February is that we have seen an increase in what we call 1-year break-evens. That's just a fancy way of saying inflation expectations over the next year. So as those inflation expectations started to rise again, we saw a concurrent fall in asset prices, and that was really a result of tighter financial conditions. So when we look at the VIX, we look at the 10-year interest rate here in the US, or we look at the US dollar, what we saw was across all three of these charts, a pretty strong rebound in February. Volatility increased. That was the result, of course, at least in our thoughts, it was the result of these 10-year interest rates increasing. And that led, of course, to the US dollar increasing, all of which lead to tighter financial conditions. And we go back a slide here, this kind of all coincided around February 2nd. And we think of February 2nd, what else happened on February 2nd? With a short-term peak in the market after a very strong January. So what caused these financial conditions to tighten back up? Believe it or not, good news. And that is actually why we are not as bearish as the consensus out there. Yes, non-farm payrolls came in at 500,000 plus jobs. And if you go back to our update a few weeks ago, we thought it was a really good number, not a sustainable number. We definitely think that those job creation numbers are going to slow down here quite dramatically. Why? Because 500,000 is a lot, even during a normal economic recovery. So when we think of that 500,000, we definitely think that's a one-off, similar to mid-22 where we saw a big one, and then early on in 2022 where we saw another 800,000 job print. Largely speaking, those appear to be one-offs. But then this is the big thing, is that the inflation numbers came in a little bit hotter than expected in January, which were reported in February, of course. And that led to that persistent sort of pullback in asset prices. Persistent but moderate pullback in asset prices. I want to emphasize that what a 5 to 6% pullback we've seen here in the markets, that's actually perfectly normal. When we look at inflation, the seasonality around inflation in January and February is a little bit hotter. Why is that? It can be for a number of reasons. The new year, and companies tend to adjust their prices in the new year. Coming off of Christmas, it is winter, so you tend to get hotter commodity prices during the winter months, such as natural gas, even though that one is actually significantly down this year. But overall, heating prices, stuff like that, tend to rise in winter. So for whatever reason, we do have this seasonal impact as it relates to inflation expectations, but then we get this drop off. So remains to be seen as whether that sort of reacceleration that we saw in the inflation number in January is part of a new rebound trend, or it's more related to the seasonals here. And that's where the charts are important. Excuse me. So what we see here with the dollar index, we believe that this parabolic blow off top for the US dollar was and is, largely speaking, a generational top for the overall US dollar. We had the strong pullback in the US dollar, breaking the 50, 100, 200-day moving average, that trend support. And now we've had this oversold bounce for the dollar. And we're getting right into a cluster of resistance here, as we would expect in any sort of Fibonacci retracement. So what does that mean? Dollar went up, gold prices came down. We do own some gold stocks. We have seen those gold stocks pull back. Commodities also tend to pull back as the US dollar goes up. So what happens if US dollar hits resistance and then starts to pull back and hit lower lows? We would expect a rebound in gold and gold stocks and commodities and commodity related stocks such as energy and precious metals and base metals such as copper and iron ore, etc. And that's how we position the portfolio. On the flip side, we think this is deeply negative for a lot of these profitless technology companies. So since the peak in February, we've seen, for example, this is the ARK ETF. This is at the center of speculative technology. We've seen that ETF pull back about 14.2% or so. We don't think this pullback is over for technology. We do encourage people to be careful with technology here. We do think it's a generational top, a bubble unwind that is taking place in technology. So be careful about chasing asset prices within these growth sectors right now. And then oil, we see oil continuing to chop in a range, right? So between $80 and $70 a barrel is where oil prices have largely been chopping around since early 2022. We think that's a positive thing because the stocks are acting better than the commodity. We look at Schlumberger here. This is one of the biggest oil service companies out there. For disclosure, we do own it in the portfolio, but we're just using it for illustrative purposes. What we see here is it's still trading near the highs. And so whether it's oil service names, E&P names, we do like how these names are trading. We like the valuations. They're trading in many cases single-digit PE ratios. So overall, the stocks are cheap. They got incredible free cash flow yields, and the charts are setting up across the board from a technical perspective. Gold, we talked about that coming right back into support, right as, and we're going to go back to this real quick, as the dollar is hitting resistance, right? So dollar's hitting resistance, right as, if I can get to it here, right as gold is hitting right into support here. So we like to set up for gold and commodities as the US dollar hits those resistance levels. And again, this is all part of a broader long-term trend that we have committed to be disciplined on, which is this shift away from profitless tech and new economy stocks back toward the old economy, which is a combination of energy, materials, and industrials. These groups are cheap, their earnings are improving, they're under-owned, and they're hated across Wall Street. So bottom line, we are continuing to navigate this chop, but we do believe that market pullback remains relatively well organized and healthy. We do think that relative performance is beginning to shift back toward those old economy stocks after a bit of a laggard start to the year. And then lastly, we do believe the resumption of US dollar weakness should be good for commodities, and that's how we're positioned right now. So if you have any questions or concerns, feel free to reach out to us, 888-543-3776. Other than that, have a great week, and we'll speak again next week. Talk to you soon.